This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com. As part of our ongoing series on financial repression, I have Professor Amin Rajan joining us this morning. Professor Rajan is Chief Executive of Create Research. Welcome. Welcome,
hello
Professor
there.
Rajan. Can you hear me?
Yes, I can hear you, and hello there. How are you?
I was wondering whether they had a good connection. It seems to be all right now.
Yeah.
Professor, maybe we could begin with you giving our listeners a brief outline of your background and your current involvements.
Yeah. I started my working life as an economist in UK Treasury. My main job was really to, forecast the key variables that affect the financial markets. And once I left the Treasury, I started my own research boutique called Create Research. And at Create Research, we look at the emerging issues in global investment. Each year, we do 2 major surveys of investors around the world. And each of the surveys try to address their dreams and nightmares. For example, the survey that we published in 2013 very much focused on this whole subject about what it means to be an investor in a debt-fueled world. We got too much debt at the moment, and this is artificially affecting the markets. And, no rules or laws of investment are working at the moment. And, there are winners and losers in this game. And the subject of financial repression as a result has really come to the fore.
There's no question the debt-fueled world, it's led to mispricing of risk, lack of price discovery, malinvestment, and I'm saying that as an investment practitioner. That's not a judgment on the economics of quantitative easing and policy. Yeah. It's a fundamental fact of where I see money flowing, at least here in Boston. How would you define financial repression before we actually get into the report itself?
Yeah. At its simplest, financial repression is a device used by governments to liquidate their debt. Now, as you know, there has been a huge amount of debt building up in the global system. It was not just the United States only, but in Europe and latterly in Asia as well. The debt to GDP ratio has now reached historically very high levels indeed. Certainly in certain countries like China, it had never experienced more than 80-90% of debt GDP ratio. Now they're talking about 230%. And the same thing has happened really in almost every country. The governments and central banks have pumped a huge amount of money into global economies to keep economic growth going. And in the process, they've created this huge amount of debt. Now, as far as governments are concerned, there are a number of ways they can get rid of the debt. Number one is economic growth. Well, we've had subpar growth almost around the world. US has, on the whole, done better than its European partners. But even in the US, the debt problem hasn't really gone away because growth has really been subpar. The second means is austerity, and that's about really cutting public expenditure. Now, when you cut public expenditure, that could be self-defeating, as you know, Gordon, because what really happens is you cut public expenditure, that really slows down economic growth, that reduces the tax dollars that is coming into the Treasury. And what happens is that austerity can be self-defeating. And what we found indeed is that when we went into the great financial crisis of 2008, the debt to GDP ratio for the G7 countries was 140%. Today, as you and I speak, it is about 180%. So there has been 40 percentage point growth in debt to GDP ratio. A lot of that has come about as a result of the self-defeating policies that we are obliged to follow. So austerity hasn't really worked. The third avenue is debt moratorium. this has proved very contentious. There are certain countries like Greece who are never going to be able to pay their debt. And, there is no way that we should be kidding ourselves about that. But nobody really wants to allow for the proposition that, there should be debt moratorium, because this could have really quite a catastrophic effect on some of the banks. And European banks are not really that well capitalized compared to the American and the Canadian banks. So that is out of the question. So that really leaves two possible avenues. One of them is to keep interest rates artificially low. This enables governments to fund their existing debt levels. But also, alongside that, the governments are trying to stoke up inflation. And what inflation does is weaponize the debt. So financial repression is about having very low nominal interest rates and rising inflation. And that means that the yield is negative, real yield is negative. And that's the way the governments have historically weaponized their debts and got rid of them. And we had that situation after the war.
Yeah, most people don't appreciate that. The United States had this after the Second World War through the early 50s. And it turned out to be quite successful and somewhat little noticed.
Yeah, that's right.
Because it was the economy was relatively strong.
In the post-war period, growth was strong, and that really did help a lot. But the fact is that, when United States and UK boast that they have never defaulted, well, they've never needed to. What they've done is they've used financial repression as a way of getting rid of the debt. And that's exactly what is really happening today. Now, it would not be so bad if we didn't really have a system of winners and losers, because if everybody was doing this, it would be fine. Except that when the government issues its debt, somebody holds that debt. And when they hold that debt, they find that the real value of the debt is falling. And that amounts to an arbitrary redistribution of income from savers to borrowers. So when we talk about financial repression, we're really talking about two very fundamental facts here. One is that it really is about it's a device used by governments to liquidate their debts. And secondly, it's a device which brings about an arbitrary redistribution of wealth from savers to borrowers, from pension plans to governments. And, this is what really makes it so innocuous in the eyes of millions of pensioners now. Now, the whole phenomena of financial repression currently would not be so bad had it not been for the fact that we've got an aging demographics here in all the Western societies, in that there are more and more people entering the retirement phase. For example, if you look at people in their DC plans, they're retiring. They need to invest their money into fixed income products that can give them regular income and inflation protection. On the DB side, there are pension plans who are going into the decumulation phase with two very negative numbers. One negative number is that their funding levels are below 100. In other words, they're not fully funded. And the second negative number is that they've got a negative cash flow. In other words, there is more money going out than coming in. And that's largely because members are retiring at an exponential rate. 78 million Americans due to retire over the rest of this decade, and another 84 million Europeans due to retire. And that is largely because of the post-war baby boom. So we're in a situation where this financial repression is occurring at a time when we can least afford it. And its effects are very regressive in terms of the impact on distribution. As I mentioned earlier on, governments are going to be able to weaponize the debts at the expense of these retirees. And that is a phenomenon that the retirees are having to come to terms with.
A very harsh one. And I'm seeing it right up front in real life, where people had planned conservatively, had put money aside, and had been making good returns, but had been told to plan for 6% and be conservative. They did that, and now they're finding they have to go and find work. And I have a friend of mine that it was retired as a dentist and now feels has to go back to work, and he can't do it because the malpractice insurance cost prohibitive, so he can't even practice his career. And I got example after example of that, of the harsh reality of this robbing of the savers. That's really, it's a wealth transfer of purchasing power that's going to the government, who's issuing, or governments, in more debt. Now, a couple points on that. How long is this going to go on? This environment's going to be sustained, and is this a formal policy, or is this just something that's evolved?
Well, if you talk to government ministers or if you talk to central bankers, they would say this is a natural evolution of what has really been going on. They are hardly likely to say that they have started something which amounts to, in your words and mine, a daylight robbery, because that's exactly what it is.
It's a lack of fiduciary responsibility somewhere.
But I think it really goes back to very lax monetary policies that we've had since 1987. Every time markets took a tumble, Federal Reserve in the US reduced interest rates, pumped extra liquidity into the system. So prices got artificially inflated. Secondly, we also had a situation where governments wanted poor people to get on the housing ladder. So people were given mortgages, at levels which were well beyond their means. So in the United States, we had the subprime crisis, which really amounted to something like $3-4 trillion of write-offs. And those write-offs, they were largely borne by taxpayers of the United States, and here in Europe by the taxpayers of UK, Germany, and so on. So we had a situation where private losses on the part of the banking system were socialized, and they were taken on the balance sheets of public sector. And that's why public sector debt has ballooned, absolutely ballooned, since 2008. And the only way you can get rid of it, as I say, is either through economic growth, that's not there, through debt forgiveness, that's not possible, through austerity, which is self-defeating. So that only leaves you to an option of very low interest rates and rising inflation. And if you look at history, periods of financial repression have lasted from anywhere between 15 years to 50 years. Mm-hmm. We're now into the 7th year now. So this show has got a long shelf life, in my view. I think it's likely to run for another 5-10 years. It may ease a lot in US because you folks have seen improvement in budget deficit, your trade deficit is improving, you got economic growth. So some of the other drivers of debt reduction, they're more potent in the United States than they are in Europe. If I can just give...
Possibly on the surface, and I say that, I just had an interviewed Professor Lawrence Kutlikoff here at the University of at Boston University, and he is testifying, in fact, this week at Congress about the fiscal gap and making it more available publicly. And he ballparks it, and statistically, and has had 500 economists, 15 Nobel laureates sign the paper, that it's $210 trillion of liabilities if you did proper accounting, and if it's the fiscal gap. And so, it's a fact. But so the numbers are so large, even in the United States, they're unpayable.
Absolutely.
That doesn't mean the world's coming to an end. It means they need to be addressed. And so what are the realistic solutions to begin to do it? Minimize, but from an investor, you've got a long-term problem in front of you that you've got to, and pension plans that have got to step up to the problem now with new strategies.
Yeah. Now, those folks who are in the DC plans, you quite rightly pointed out, Gordon, that they're going to have to work longer.
Yep.
They will have to save more, and they'll have to spend less. That's for sure. Now, maybe they can cope with the phenomena because individuals can have their own survival strategies. When it comes to, but even then, according to a congressional budget report, those DC plans are in deficit to the tune of $7 trillion. In other words, these folks' pension plans are worth $7 trillion less than they need to be. Now, we're talking about serious money here. Then when you go to the DB plans, the situation is the same. Big deficits in public sector plans. These are not parked inside balance sheets such that they're shown properly. But in the private sector plans, the story is the same. If you take private sector plans, plan balances, they are short by about $3 to $4 trillion. Now, those balances have to be met by corporates having to make cash injections. And many corporations haven't really got the money to put into these pension plans. So, for example, if you take British Airways pension plan, the market capitalization of British Airways pension plan is far less than the deficit on the plan. Now, that puts the whole question into perspective. How is British Airways ever going to meet its pension liabilities? Nobody knows. There is a big hope that, something will happen, a miracle would happen. In the meantime, everybody's kicking the can down the road.
Making the problem bigger and worse. And that's exactly, in the United States, the public pensions at the state and local level are underfunded close to $5 trillion, $4.7 trillion worth.
That's right. Yeah.
Public, the corporate, I haven't seen any hard statistics on that, and those are pretty astounding.
Yeah.
And so you total it up, and so that problem, as more and more people are retiring and drawing out, it's almost like a Bernie Madoff Ponzi scheme. And the same thing that happened there. Is that a bad analogy?
No, it's not a bad analogy at all. In fact, in the defined benefit plans, that's exactly what is happening. So if I'm a member of a DB plan, I'm retiring now, there is still some money in the kitty there. But what is really happening is that as I take the money out as a part of my entitlement, the level of balances are going down. And in order to replenish that, these plans really need to have bigger and bigger returns, and they're not getting those. They should be invested in fixed income at the moment because they can't afford to take risk while they enter into the decumulation phase.
Financial repression, by its nature, forces you to take higher risk for the yields.
Yeah.
And therefore people who, and I think to quote you, people who least understand risk are being expected to take it on.
Yeah.
And are incapable of managing it.
This is the biggest paradox of the current situation. So, we use a wonderful phrase like personalization of risk. We want to empower people to make their own retirement planning. We want to empower people and give them the tools to make the right decisions and so on. But at the same time, the kind of assets they can invest in, those assets are so artificially inflated that when the bubble comes, when the bubble busts, we're really going to see a huge market correction. So many have been forced to get out of fixed income products and go into equities. Now, equities are highly inflated at the moment by any criteria, in my view. Yes, the US economy is stronger now. UK economy is a bit stronger. But in my view, the earnings expansion, the expansion in the earnings multiples that we've seen, they really require a growth rate which is supposed to be somewhere near 5% rather than 2.5%. We need double the growth rate to justify the current earnings expansion that we've seen. So we're in a situation where, we're all in the same boat, and we've kind of stopped worrying because, the Fed has got the punch bowl still there. And if the Fed starts increasing interest rates, very soon Fed is going to find that it's not really going to work because on the mortgage side, a lot of people would not be able to pay their mortgages. And we may well end up in a situation where, there will be huge defaults, and we could well be back in a situation where we were 5-10 years ago. So the Fed's got to leave the punch bowl there. We're creating a new punch bowl here in Europe from next month. 60-90 billion dollars worth of asset purchases are going to be made every month and so on. So, yes, we're going to inflate the markets. And, this is not the best way to do it. But if you ask me to put my hat on as an economist and say, what's the best option? Well, I would say quantitative easing. It would not be my first choice or would not be my last choice, but it would be my only choice. That's all we're left with. There are no policy tools left in the bag anymore. And that's why we have to rely on these unorthodox ways of curing the deficits.
We're relying, at least in the States, primarily on monetary policy without really substantial fiscal strategy, fiscal and public policy to address secular kinds of issues.
That's right.
And we're relying on one thing, cheap money. And at some point it becomes destructive. And that's what happens when you get, as I said earlier, mispricing of risk, lack of price discovery. As you correctly point out, I also believe the market is strongly overvalued by any measure that I look at it, but it doesn't stop it from going up and diverging as PEs are expanding and GDP numbers and profits are all falling and sales are falling.
That's right.
And so it doesn't mean that it won't go on, but at some point markets will overwhelm anything that's artificial. It's almost inevitable. but how long, we don't know. But so what it means is during that period, you're taking on substantial risk potentially, whatever type of investor you are, professional or individual. So in your excellent report, what were some of the highlights of your report from a solution standpoint of what people should start thinking hard about?
So in the report, we made a distinction between solutions alpha and product alpha. As the name implies, product alpha is about investing in order to beat the markets. Solution alpha, on the other hand, is to say, don't try and beat the markets. Don't go with the crowd, because these markets are really going to end in tears at some stage. So when you're planning for retirement, think about exactly what your needs are. And then think about asset classes which will help you to meet those needs. Shoot the light out type returns are not really an option anymore, because they involve huge amount of risk, which one can take when one was young and has got plenty of time to recover from any losses. But for retirees, there is no time to recover, because once markets drop, say, by 50%, then they need another 100% growth to get back to the original level. And those kind of growth numbers, they're not really likely to materialize in the near future.
I know many people between 2000 and 2008 drawdowns still have not recovered in spite of what has been an incredible market run.
Yeah, you're looking at one of them.
Okay, so and these are smart people. Yeah. And when you put it in real terms, not just nominal terms, it's even worse.
Oh, yeah, it is. Yeah, we've had about 25% inflation in the meantime.
Yeah. Depending how it's measured, and even the inflation numbers are sometimes questionable, and they're higher, which makes the returns even worse. But that's a good way of looking at what solutions alpha is. So how do you determine that? You determine it with your needs. You say, this is what I need. Don't worry about the return I'm going to get on the capital. Worry about the return of the capital.
That's right.
And it's going to be secure, minimum risk, and that's your starting point.
That's right. Now, Solution Alpha would enjoin people to look for three things when they do investing. One is to get a regular income, because that's what retirees need. Two, to see if they can get some inflation protection as well, because all this liquidity which is being created, we don't know where this liquidity is going to end. At one day, at some stage, inflation is going to roll back. So think about investing in assets which really give you a measure of inflation protection. And the third target is low volatility, because as retirees, one cannot afford to take big hits, because it takes a long time to recover from big hits. So investors are now being enjoined to look for asset classes which really give one or more of those three benefits. Not easy in today's climate, but more and more retirees are wising up to the fact that they'll have to really look at the world of investing through completely new eyes. The old ways of investing isn't really going to work in a climate of financial repression.
Can you give some specific examples there?
Okay, so one of the asset classes which has done exceptionally well is real estate, property, as we call it here in Europe. Now, property at one time used to be regarded as a surrogate asset for equities, And at one time, pension plans in the United States and in Europe, they had allocations of something like 25% to equities, somewhere between 20 to 25% in the 1970s. As equities took off, the allocations to property declined quite substantially, to the extent that, say, in UK, average allocation to property was 5% in 2005. Now it has doubled to 10%. The reason is that property has got a number of characteristics which really meet the needs of investors. First, you get an upside because if there is inflation, property prices keep pace with inflation. Second, you get regular income through rental incomes. Third, you also have a regular cash flow. And fourth, there is inflation protection as well, because real estate values they do tend to rise with inflation and so on. So the whole perception of property as an asset class has changed. It's no longer sort of seen as bricks and mortar. It's more and more seen as a hybrid asset class. which can generate one or more of those four benefits if you're invested in, say, commercial real estate or private real estate. The same thing with infrastructure. For example, and also the same thing with farmland. If you go to countries like Sweden, huge investment in forestry and farmland there. People are taking 30, 40-year view there because they've come to the view that these are genuinely uncorrelated assets, and these assets have got huge potential from a long-term perspective because they are going to deliver things which run with the grain of the needs of the emerging economies around the world. Timber is always going to be in great demand.
Timber, farmland, real estate, these are all things that are considered hard assets.
Yeah, that's right.
And that the whole hard asset range goes on quite extensively. It doesn't mean they generate sustained income, but that's another element, as you point out.
It doesn't necessarily generate sustained income for all the investors. But say, for example, if I was a large institutional investor,
okay,
that's where I would put my money. For example, let's look at sovereign wealth funds now. They're the biggest investors in the world. They've got real estate allocation somewhere between 15 to 35%. That's the amount of money that they put in real estate. Some of them have also put something like 10, 15% in farmland. Yeah, they're taking a much longer term view. Pension plans in the United States and also in Europe, they're investing heavily in farmland. Many U.S. pension plans are invested heavily in countries like Chile, for example, and in countries like Argentina as well. Because these countries have got very fertile land, very good climate for regular crops and so on. So people's views about these hard assets are really undergoing a very fundamental shift. And I think that is likely to continue while financial repression starts. Now, let's go back to the two traditional asset classes. People have always invested in equities and bonds. Bonds, at the moment, they are massively, massively overvalued. We've had a 30-year bull market in bonds, and prices are highly artificially inflated, and largely because of central bank action.
As overpriced as the equity markets are, I think the bond market's even worse, in my opinion.
Absolutely. And the worst thing about bond market is that when the correction comes, as it surely will, liquidity is going to dry up in no time at all because of the Volcker rule. The inventories of bonds that investment banks are carrying is about 1/8 of what they were before 2008. So if there is a mass exit, there isn't really going to be liquidity. There aren't going to be any buyers of those bonds, and the prices will drop like a stone.
Well, with the amount of leverage that's going on and the reuse of collateral through things like rehypothecation, any kind of drop in collateral values immediately cascades. I'll call it margin calls for lack of better, but immediately you're going to have liquidity and counterparty risk concerns.
Yeah.
And what 2008 was really about was the short-term shadow banking asset-backed commercial paper suddenly seizing up, slowing up, and it was every man for himself in a big hurry.
Yeah. And in fact, to his credit, our new governor of Bank of England, Mark Carney, a Canadian, he actually mentioned this point recently in a speech, and he said, we're very aware of the fact that the liquidity can evaporate overnight in fixed income market, and so it's quite possible that central banks will have to move in once again as lender of last resort. So, that's not a good asset class to be in at this point in time. Well, certainly one wouldn't really want to increase one's allocation to fixed income.
The problem might be, just to interrupt there, that when we had it in 2008, it was primarily a U.S.-centric problem. If something like this begins to happen, it'll be global with multiple countries and central banks. And that is a very difficult thing to start in a coordinated fashion addressing. It could quickly and rapidly escalate, and because things happen at electronic speed today, obviously, and computer driven.
That's right, and I think a lot of people have forgotten the fact that there is a limit to what central banks can do. Even with U.S. Federal Reserve, the amount of money the Federal Reserve has really pumped into the system. There's a limit to how long they can go on inflating their balance sheet.
Well, Alan Greenspan is out already. Alan Greenspan himself is warning about the levels of these asset prices. And he's saying they're higher than ever than he's seen before, and he's lived through he created some big bubbles.
Oh, he did indeed, and he has recounted. So
he has seen the light.
He's seen the light at long last, but it's too late. And then on the equity side, central banks are trying to inflate equity values in order to create what is called the wealth effect. Make people richer, and as a result of becoming richer, they're going to put more money back into the system, and there will be a trickle-down effect in the rest of the economy. Now, that wealth effect has been nothing like as powerful as it's made out to be. So we've got a situation where equity markets are highly inflated, but the effect on the real economy is nothing like what was expected.
Well, the wealth effect has been there, but in a very small percentage, and so therefore it hasn't moved to the economy. I see it with over 50 million people on food stamps in America. Yeah. I see it on the lineups at food cupboards of kindness and food kitchens for handouts. They're around the block with cars waiting. These are charity food banks.
Yeah.
These are like the Depression-era soup kitchens. And I mean, they're there if anybody wants to see them.
Yeah. The sad fact, Gordon, is that our societies are becoming more and more unequal, not only in terms of wealth distribution, but also in terms of income distribution. And that's why you find that the wealth effect hasn't really trickled down on a scale that, both Alan Greenspan and also Ben Bernanke were expecting. And we have a similar worry in Europe as well, that, we're embarking now on a QE program in Europe. It's going to be just as ambitious as the Federal Reserve's QE program. But there are deep worries about really whether that would really have an effect on, Joe public in a way that is intended. My basic point is this, that we've created, as a result of this excessive debt, we've created what I call a balance sheet recession. This recession that we've got is a balance sheet recession in the sense that, there is too much debt, and people are preoccupied with paying back this debt. And in the process, we're creating more debt. So it's a question of tiger chasing its own tail. Now, we need to go back to those three things which really haven't worked, and we need to sort of see how we can make them work. First, we need economic growth. Once we have economic growth, that's going to help both sides of the balance sheet. There'll be more revenue coming in, and also, there will be less strain on public resources in terms of welfare benefits and so on. Second, we need to think about reforms. The entitlement programs that you folks have got in the US, entitlement programs that we have in Europe, they cannot be funded. Let me just give you one number. Europe accounts for 8% of global population. It accounts for 25% of global output, and it accounts for 48% of global welfare budgets. Now that puts a whole question into perspective. We cannot afford to go on having these entitlement programs because they are a huge drain on resources. It was very noble and enlightening to have programs like Great Society during the period of President Lyndon Baines Johnson. It was a great idea. I remember reading about it as a student, and I thought, what an enlightened move. Now, also the same thing about pension promises. It's wonderful to promise people a decent retirement. It's a mark of a civilized society. What we didn't quite realize was that this pension promise will really come to materialize at a time when we can least afford to pay it. And the least afford to pay it fact really comes from the fact that, our economies are so heavily indebted now that, we don't really have economic growth of the sort that we need. We don't really have quality growth. And so we need to really go back to the pension promise and indeed all the entitlement programs and ask a fundamental question, whether we can afford them or not. Now, politics being politics and politicians being what they are, they don't really like to address that issue. So it's a can which is being kicked down the road yet again.
Where does it end? What do you think the likely outcome will be?
Well, one can think in terms of scenarios. I'm a sort of optimistic person by nature because, human civilizations have survived catastrophes. I've just been reading a book about the collapse of Roman Empire. This was a great empire. It was Romans who invented the whole banking system. The word credit, its Latin root comes from the word trust. And they created the banking system, they created monetary system and so on. And then they started to debase the system, by reducing the gold content of the coin. And that debasement process really ended in the collapse of the Roman Empire. But out of the collapse, something really good came out because people realized that, the old ways of doing things were a recipe for disaster. We got to start all over again, which is what they did.
As soon as you move away from sound money and you start to debase currency and easy credit, you're on a road that's almost non-returnable. You're on a path, and because it only escalates and makes things worse and worse. It's like inflation. Once it gets out of the jar, it's Volcker had an impossible job trying to put it back in the jar.
Yeah.
And for those that can remember back in those days,
it's like drug addiction. Our economy now only functions as a result of huge amount of credit in the system. Even the Chinese are recognizing now. So China should really be cutting its debt now. China should be reining back. But China also needs 7% growth rate to feed a population of 1.3 billion people. If it doesn't have 7% growth rate, there could be a huge amount of social unrest. So China is choosing a lesser of two evils and saying, okay, let's just pump more money into the system and hope that, growth will help us to rectify all the problems that we've got. So one scenario is really that, we will learn the lesson through the hard way, and then, we will really have to sort of think about a different monetary system and so on. At the other extreme, the scenario is that, we will suddenly sort of realize that this way of running our societies and running our pension systems is not really the best way, and we really need to have a very serious debate about this. And we need to have a completely new social contract and rewrite the contract where people accept the fact that there was not going to be the entitlements of the sort that they've had in the past. And there is a middle way, which is all about muddling through. So we will do a bit of that. So, we will stimulate growth. That would help to ease the pain. That would help to ease the pressure on finances. And then there will be a little bit of tinkering after the midterm elections and so on. Go back to the entitlement program and see if some programs can be trimmed in this way or that way. And so, my view is that there's going to be a lot of tinkering with the system and tinkering at the edges. I do not see a fundamental reform of the system simply because the retirees are a very powerful pressure group. These are the folks who actually turn out to vote in all the elections. Young people don't bother to vote in Europe. Not sure what the situation in the US is. Or certainly not many young people turn up to vote in proportionate terms. So we have created a problem here, which is very, very hard to face without open, honest dialogue on the part of our leaders.
And I'm skeptical about the growth. That is the big problem. We just don't have real economic growth, and I question whether we really have a working capitalist system versus what I'll call a credit system. Because today it's all about, what used to be a capitalist system was about savings that was reinvested, and that reinvestment was into productive assets that would create wealth. Today what we do is we create credit to drive consumption. The growth is all in consumption. But that consumption doesn't have any return on investment that will handle the debt. There's no money to come out of that.
That's right.
So when you start to artificially do that, you get into huge problems. An example: last quarter, 90% of the 90% of the profit of the S&P 500 was returned as buybacks and dividends, which means a maximum of 10% could possibly be even available as investment capital, which is where the growth comes from.
Yeah, that's right.
It doesn't make sense. They're not doing it.
No.
So you by definition, you've cut off any potential for growth.
Yeah,
we have one company or two, I'd accept it, but S&P 500.
We've got so many worthy projects in which we should be channeling funds, and that would help to improve the productive potential of the economy. It would create new jobs. It will create viable jobs, and so on. But we're not doing that, Because what is really happening is that what we want to do is to invest in such a way that gives you very quick paybacks. And this statistic that you gave, about 90% of profits, being plowed back into the system through buybacks and very high dividends in order to inflate the stock prices. That's resulting in something which is very, very detrimental to the long-term interest of our economies, which is that our financial markets are becoming over-financialized. In other words, stock markets are not acting as a channel for diverting capital from those who are savers to those who need the capital to create productivity and growth potential, but there is trading on the stock markets just for the sake of it. So we're seeing over-financialization of markets. And this leads to distortion in prices. This also leads to devices like high-frequency trading and dark pools. All manner of things are now being created such that people can take advantage of very small price anomalies and in the process make billions of dollars of profits. So, the capitalism that you and I live in today, it's, in my view, lost social expression. We don't really know what it's about. And secondly, it is heavily over-financialized to the extent that it's really losing its original motive of generating wealth and, creating skilled workforce, investing in technology and all sorts of things, which has made the United States great, which has made Europe great, and so on. We're miles away from the original goals of capitalism.
We've had in the United States, we used to create new firms, small ones starting up, other ones failing. We used to run them around 200,000. We've lost 70,000 in the last 6 years, net loss. More failing or leaving or shutting down than starting. That is a scary statistic, and I only have to drive around to see it firsthand.
Yeah, I mean, there are a lot of very disturbing statistics about the U.S. that, underlying this booming so-called labor market, there are a lot of people who have opted out of the labor market completely, so the size of the workforce has come down. Now, that's not so bad if productivity is increasing. But productivity is not increasing at anything like the rate which is needed to sustain an aging society and aging population. So there are some worrying trends there. I think in the U.S., one bright spot is really energy self-sufficiency.
Yes.
That makes a huge amount of difference. What is needed in the United States is a real consensus about, what does the U.S. really stand for in terms of, where it wants to go, what it really wants to achieve. What are the long-term goals? And as a part of that, there needs to be a debate about the entitlement programs. As a part of that, there also needs to be a debate about youth training, and about poverty and so on. Many of these issues get shoved under the carpets because these are very uncomfortable issues to discuss on the part of politicians. And we have the same problem in UK. Politics is a matter of sound bites, quick, clever sound bites. And those sound bites have become substitute for action. And in the process, what we're doing is we're loading our children and our grandchildren with huge amount of debt, which is just unbelievably big. When I look at the numbers at the moment, it is absolutely massive. And, you quite rightly pointed out about the amount of debt which is parked outside the balance sheets. That is absolutely huge. US, huge. Europe, huge. And at the moment, there isn't a strong will on the part of politicians to look at this problem fairly and squarely and say, we've got to tackle this.
It takes great leadership. It takes real courage. It takes remarkable leadership to even address these kinds of problems. I don't envy it, but to me, one of the big central problems we have globally is a lack of strong political leadership.
Oh, absolutely.
And it starts right there, and quickly. When you get into practices of unsound money, which is effectively what we have, you put good people in impossible situations, trying to make something that's unworkable work. And then you get deviant behavior where bad money forces out good money.
Yeah, we are exactly in that situation. And that's why financial repression is such a soft option. Yeah. Because by prolonging financial repression over a 20, 30-year period, debt could be brought down quite substantially.
When I raise this with a lot of people, generally, they think that financial repression is some kind of conspiracy. And it's not. It's just a practical solution.
That's right.
I don't say I like it, but it's a practical solution if you're responsible for a government to stay under control with your debt. They have no other, as you point out, 4 options. They have no other. It's the only workable option. temporarily.
And also, it's something which is not, the pain of that is not immediately felt, because I quite rightly use the word, the debt is vaporized. It's vaporized gradually, such that the debt is still there, but it's not worth very much in terms of its purchasing power. And, so people don't feel the pain immediately, but they surely will feel the pain over a period of time, particularly with aging societies and people living longer and so on. And this problem is a serious one. There's no doubt about it.
Well, we're up against our hard line. Some great comments. Any closing comments that you'd like to leave with our listeners? Key messages?
My key message would be that as a phenomenon, financial repression is here to stay. As I said earlier on, for governments and central bankers, it's not their first choice or their last choice. It's their only choice. However, the kind of implied redistribution of income means that the savers are going to be the losers, and savers need to really wise up to that fact. And when it comes to investing, they need to be much more vigilant about where they invest and how they invest. Don't follow the advice of the advisors, because advisors are very conflicted in this game. You really have to use your sixth sense to survive in today's world. And I would really like to implore the viewers that, think very hard about where you put your money and ask as many questions as you possibly can to your advisors before you really commit your money, because your money isn't going to be worth a great deal 5-10 years down the line.
Very, very sound advice. Could you tell our listeners, where they could learn more about your writings or where they could find more on your work? We're going to post this report so everybody can have a chance to look at it, but it's only one of many that you've done. All our reports are put on our website,
www.create-research.co.uk. The details are also given in our report. We've written some articles as well. They're available on our website, but if you'd like to put them on your website, I'll be very happy to send you those articles. And finally, the report has been so successful that we've been asked to visit the whole subject of financial repression, which we are in the process of doing through another major global survey, which we hope to publish in November. So watch this space. We're going to come back to this subject again in November.
Well, maybe we'll have you back then and really focus on that report, because I know our listeners will want to know more about more of your findings.
I'll be delighted.
Everything you've said is, in my opinion, right, absolutely right on the mark. But in the report, it's not just some of the negatives, because we've kind of dwelled on negatives here today. There are solutions. There are approaches. Society's going to survive. There's going to be some difficult time. The one thing you can trust in is humanity's ability to survive.
Absolutely.
But these are going to be difficult times. But they don't necessarily need to be. If you do your own reading, do your own research, get good advice, there are solutions out there, and you're identifying them. So, and others are too. Others are actually working on solutions for this. This is not what's going on? There are very smart people with very good solutions globally that are solving these problems today. And you mentioned some of them. So
yeah, and the key thing is for investors and for your viewers, the key thing is really do your research, do your homework pretty well before you commit your money to anything. Because in the world of investing today, nothing is what it seems. It's a big hall of mirrors. It's got a sense of infinity. Nothing is what it seems. And so don't take anything at its face value.
It's like credit is confidence, right? So it starts with where should you place your confidence? Thank you very much. I appreciate the time, and have a good weekend.
You too, Gordon. Thank you very much for involving us, and good night.
Thank you very much. Bye.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.